Hi, my name's Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And welcome to the 6th episode in my series of 8, where I'm talking about the rules or comparing the rules in Investopoly versus Wealth by Design, my new book, which is out next week. Very excited to, see the reaction or if there's any reaction or feedback, but I hope you enjoy the book nonetheless. Anyway, the rule in Investopoly was called invest in the share market using low-cost passive investment methodology. I've rewritten that in Wealth by Design and changed it to invest in shares in an evidence-based way. And the reason that I made such a significant shift, I think it's significant, and I'll explain why it is significant, is that the success of the ETF market actually broke the rule. So back in 2017, the book was published at 18, but I wrote it in 2017. Back then, ETFs, there was about $25 billion invested in about 130 odd ETFs back in 2017. Today, there's $350 billion invested in more than 450 different ETFs. So rule number 6 in Investopoly was mostly just about index investing and trying to pitch why indexing versus active and direct stock picking is a superior strategy, but really indexing is one. And so now the victory means that there's a new way to lose money, that is choosing the right index strategy. So back in 2017, 2018, the enemy was active funds management, expensive active fund managers, high fees, poor returns, might get great returns 1 or 2 years in a row, but then, fall off the face of a cliff. Also, the enemy was direct stock picking, subscribe to a stock newsletter, pick which stocks you think are going to beat the market and try and outperform net of turnover and fees and taxation drags and so forth. Well, they're no longer the enemy today because everyone's investing in ETFs. So the enemy is actually hidden inside the thing that I recommend, which are ETFs. We still invest in some unlisted managed funds that don't have an ETF version, but that's becoming more uncommon these days. So the enemy hidden inside ETFs is the fact that there's one launched more than one every week. So in 2025 alone, there was more than 70 ETFs launched in Australia. And so now everything is just about what's popular, not everything. A lot of these products are really targeting what's popular and trying to appeal to investors to attract money. So the risk has really changed from, investing in overpriced active management to accidentally, making a narrow bet or buying index that wasn't fundamentally sound. And that's why the rule has pivoted from index investing as a sort of broad concept to evidence-based, rules-based approach to make sure there's some fundamentals underlying the ETF that we're using to invest. So just as a quick recap, in Investopoly, I spoke about the 4 mistakes that I saw most do-it-yourself investors make with a share portfolio. So typically you'd meet clients back then that have, some direct stocks, maybe some ETFs, although it wasn't that common back then. Typically direct stocks, a portfolio of 20 or fewer, so not enough diversification in there. They'd normally all be Australian stocks. There'd be no methodology. There'd be 18 losers and 2 winners. So the portfolio might be break even or slightly in front, but it's only because of those 2 winners. And typically there'd been a history of kind of chasing profits or chasing quick profits. So quite a bit of turnover, not great performance, relative to the index. And they're the mistakes, that I said, let's try and avoid. Let's get a methodology, let's invest for the long term and have patience doing so. And let's make sure we build in enough diversification in a portfolio. I also made a case around active versus passive. I think that's kind of a moot point now. I think most people understand the benefits of index investing and that active managers are expensive. Not to say they aren't worth using aren't worth using at all. So there's going to be some scenarios where we will still use active management. So for example, in emerging markets, indexing has a lower success rate compared to developed markets. So the case for indexing in emerging markets isn't as strong as in developed markets. I certainly talked about the fee drag in terms of, paying 1% versus paying 0.3% and the compounding impact of that. I did touch on in Investopoly, fundamental indexing and factor-based strategies, including dimensional, but it was really just only a quick mention. And a couple of things that I've completely changed that were in Investopoly, I laid out a sort of template asset allocation for a ETF portfolio, and I had 45% invested in Australian shares. I wouldn't do that today. And I dismissed equal weight outright as an index methodology. I wouldn't do that today either, but I'll speak more about those a little bit later in the podcast. Okay, so let's talk about the things that I've tightened in Wealth by Design. So, really it's about interrogating an index and its construction and appropriateness and use. And really what we're trying to do is avoid shiny objects. We're trying to avoid making substantial active bets. We're trying to stick to as close as possible to the underlying roots of index investing, which is, the price discovery mechanism that occurs in markets is the most efficient way to allocate investments. And that is true to some extent, but we shouldn't move too far away from that. And I remember there was a interview with Bernard Melke, who was one of the founders of Vanguard, founders of indexing, really. And the interviewer put to him, that index investing has its traditional market cap indexing investing has its shortfalls. And he goes, yeah, I acknowledge it, but it's still done really well. And now that's could be a changing landscape because, as I said, the emergence of more indexing strategies will sort of change the data set. Because previously it used to be traditional market cap indexing versus the rest of the market. But now that analysis needs to be tightened a little bit because it should be traditional market cap indexing versus other indexing methodologies versus the rest of the market. Anyway, I talk about in Wealth by Design, 5 things that you really need to interrogate and understand before adding an ETF to your portfolio. So firstly, what does it own? What sectors, what geographical markets, what individual companies, what does it own? How does it weight the index? So what are the filters? What are the inclusions or exclusions? Are there any rules or caps in regards to limit sort of concentration risk? How often does it rebalance? So how often are we going to do some trading to kind of rebalance? And what sort of mechanism are we using relative to rebalancing? So for instance, and I've done a podcast on this a few years ago, momentum investing, which is buy the stocks that have strong momentum, hold them for around 9 months and then sell them. That's the methodology behind momentum investing, is that the things that have momentum tend to have them for, 6 to 12 months. And so, buying what's hot's a good idea. But if we're doing rebalance on momentum investing, we will probably want to do that rebalance more often than not. So probably more than once a year. But also there could be the trading cost drag associated with rebalancing as well. So there's no hard and fast rules here. You've really got to understand the index and then relative to that understanding, work out, well, how successful are we going to be in rebalancing? Is that going to add an additional cost drag? And then last 2 is, concentration risk. Am I making a concentrated bet? So am I putting all my money in this ETF that's all in technology? And how does that fit within my portfolio? So does that feel like a massive bet? We don't back markets like as in sectors at Pro Solution. We don't back thematics. We still use an evidence-based, broad-based approach. And in the long run, that's what's going to win because no one can pick which sector or which geographical market's going to outperform over the next period of time. And the last one is the frictions that can erode returns. So fees, spreads, and tracking. And that's why we like to see, we wouldn't invest in a new ETF, even if we love the methodology behind it and the manager, we would want to see how it performs live. So there's some indexing that, can look great on paper, and in a white paper, a peer-reviewed white paper, it can hold up quite well. But in real life, and momentum investing is one of these, in real life, sometimes it's too costly to implement and the results move too far away from the actual underlying index. Now, in Investopoly, as I said, I talked about equal weight indexing and suggested it wasn't a great indexing strategy to use. I thought at that stage, it didn't have enough kind of methodology behind it, just to put 1/200th of your money into each of the top 200 stocks in Australia and the ASX 200 index, for example, or 1/500th into, all the constituents in the S&P 500 index just didn't make a lot of sense. But I think I've reframed that analysis as looking at an equal weight index as more of a mid cap to small cap product, because what it's going to do is you're going to be really underweight large cap and you're going to be overweight in the US mid cap, in Australia small cap, because Australia is such a smaller market. So if we do want to create more diversification in a portfolio, I think it does have its place, but you've got to be careful because mid and small cap tend to have over time larger volatility, and it's going to depend on what your viewpoint is how well or how attractively priced the mid cap and small cap of a particular market, and whether it does give rise to better sector and industry diversification, or whether it creates any concentration risks. Remembering that one of the previous rules was a value aware asset allocation, so we want to be value aware when choosing an indexing strategy as well. In Wealth by Design and on the podcast, I've spoken about choosing the right index methodology or approach for the market and the market opportunities and risks. So for instance, if all the media is around, we're really concerned about the value of US stocks at a traditional market cap level, well, the response could be, let's use a value-based indexing strategy like VVLU or VLUE, those two ETFs, to still get access to the US market, but on a value base. So that way we're going to exclude companies that look overpriced. If in the Australian market, for instance, we're worried and we think, well, look at the miners, they're pretty fully priced, the banks are pretty fully priced, they make up most of the market, so where are our returns going to come from? Well, one way is then to use perhaps fundamental indexing, a mid-cap product or an equal weight product to deal with the risk that we don't think the large cap stocks are going to generate much of a return in Australia. We still want some exposure to Australia, and so this is a better way to do it. So it's really about understanding the market, understanding its risks and opportunities, and then selecting the index strategy that best suits those risks and opportunities. As I've touched on already, we've got a really strong conviction to avoid thematic investing. So trying to, place an AI trade, for example, or clean energy trade, or, forming a view on what sector or industry or geographical market's about to take off. I remember, over the last couple of years, people have been talking about India. Like, will India gain from when China had some trade tensions with the US and so forth? Would India benefit? Maybe we should start investing in India. That all feels like active management. So really what I talk about in Wealth by Design is use the traditional market cap index allocations, kind of your benchmark, that, okay, 75% is invested in the US. That's kind of my benchmark. And then I'll tilt. I might make strategic tilts and maybe reduce my US exposure to, say, 65%, but that 65% is value or quality in terms of index methodology. I'm not going to do any traditional market cap indexing in the US, but the Europe, UK and Japan looks okay, so I'm going to do index investing in those markets or sectors. But what I'm not doing is making massive bets. I'm not saying I'm not going to invest in the US anymore, nor am I going to say I'm going to put everything in US large caps and technology stocks. So start with your investable universe. Sure, make a few tilts, but don't take massive bets and don't adopt thematic investing. One major change, I think, again, from Investopoly to Wealth by Design is really the dilution of the home market bias. So I think it's two rules working at the same time, because a value-aware asset allocation invites you to think about, what are you buying and what price are you paying for that? So what are your potential upside and what price are you paying? You want, a high potential upside at a very attractive price. That's ultimately where you want to put your money. And so we have moved further away from this home country bias and really starting with our investable universe is the global market. And we can access that market now very easily and very cost effectively, noting that Australia only represents less than 2% of that total developed market. And so we want to think very carefully about how much we want to allocate to Australia, and we've been gradually tilting portfolios more to international. And for new investments, in terms of new capital, we haven't really been investing much money in Australia. That's not to say we will never do it. It's all relative to potential future returns and the price that we're paying for that exposure today. So if those metrics became attractive again, of course, we'd be on board. But I think it's a much better way of approaching it as opposed to just having this kind of stupid way of going, well, this is the traditional approach. We've got to have 30% of our portfolio in Australia. Let's do 30% in Australia, just much like the super funds follow. It just doesn't make any sense to us. And remember, what we're trying to do is maximize long-term returns for taking the lowest risk. I think it feels risky to invest so much in a market that is so small, so dominated by certain few sectors, and has some of the characteristics that don't drive growth, which means they pay too high dividends, they pay their profits out, they don't reinvest it to create growth, whereas global companies do. And finally, the other shift from Investopoly was around fees. So, I said I was really aggressive around fees in Investopoly. Don't pay any more, absolutely minimize. I think I'm a little bit more flexible now where it makes sense, where the index methodology or if it's active manager, if there's evidence-based approach suggests that this is a better approach. I'm really focused on returns after tax and after fees rather than before tax and fees. So if it justifies paying a slightly higher fee, then that's fine. Weighted average cost of our portfolios is around 1/3 of 1%, right? So they're still very cost effective, and there's going to be some products that are much cheaper than that and some products that's slightly more expensive than that, but we're not as rigid. And I think it's really about reducing risk in a portfolio and hopefully exposing it to higher future returns. So there you go. I think they're the major changes. Remember, Wealth by Design, if you haven't pre-ordered it, it's out live. It'll start being sent out by Amazon and other bookstores next Tuesday. So we're only a few days away from it. I'm excited for you to receive it and then start using our companion tool that I've built to go along with it, the Notebook LM model that will hopefully help you apply the concepts that you learn in the book to your specific circumstances, do research, and just improve the value that you get from the book. So if you haven't already ordered a copy of the book or someone that could benefit from it, please do share either this podcast or the link to buy the book. I'd greatly appreciate it. So in next week's episode of this series, number 7, second last episode, was all about property, where I talked about only buy investment grade property. I've reframed that as buy property with enduring, scarce and growing demand. Might seem like a play with words, but there's been some fundamental shifts in that rule as well. Okay, until next week, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.